So what's up guys, it's me here again VKFX. So today we'll be talking about top-down analysis. So what is top-down analysis? Top-down analysis is a process where you intend to shake the higher time frame and scale down to the lower time frame. So we as a day trader, we trade by what the higher time frame tells you. You have to know what the higher time frames actually tell you, the bias. So you have to know the bias of the higher time frame for you to know what to do at the lower time frame. You understand? So for example, you shake your daily time frame. Let's say this particular structure, this structure you are seeing here, and make it expand. This structure you are seeing here, that this structure shows you that, oh, this market is an uptrend, right? Because it keep breaking structure to the upside, right? After I broke structure here, it broke another structure here, came up, came down a little bit. Now it's moving up, so it tells you that, oh, it's keep breaking structure, keep breaking structure. We should be expecting more of what, more of a buy. We should keep expecting something like this, right, to the upside. So because of you have seen what the market actually tell you on the daily time frame, you can come back to your 4 hours time frame, because on your daily time frame, those candles you are seeing, it just appears as, it appears as like one candle or two candle. But once you come down to your 4 hours time frame, it intends to like be clear to you. You see the whole direction very very clear. So this, you can see what happened here. There was a demand zone that market came to react to. Might be demand zone. There was a demand zone market came to react to, and this was a liquidity. It was the first pullback it made before this zone. So market reacted to it. So imagine you saw market react to this zone. So what should you be looking out for next? It should be buy, right? So and the minute market reacted to this zone, then you come to your lower time frame. Let's come to our lower time frame now. That is, yeah, let's say your 30 minutes time frame. So you come to your 30 minutes time frame. Immediate market reacted to that zone, then you look for a confirmation. See, after retesting, this was your breaker block, right? This was your breaker block after the liquidity. This was your first pullback market made. So this is your liquidity. Market came to retest your breaker block and went up. So imagine you set this as your first TP and you enter the market from this zone. Then your TP is over here. Then you set your stop loss. You set your stop loss below here. Excuse me. So the stop loss should be something like this. So this 1:7, right? So just the same thing. You keep looking out for sales, buy in the market, because you are still expecting more buys. You wait for it to break above here, right? This zone becomes your breaker block. So you wait for the first pullback, your liquidity, then you enter from your breaker block. You buy up again. So what the higher time frames actually telling you is what you should follow. So imagine these zones, these zones now, from down here to up here. Here market was actually selling down, and same movement on the higher time frame. Let's come to the daily time frame to be sure about the sell. So let's come to 4 hours so you guys can see it clearly. You can see very well what happened here. Market sold down from this spot to the other block. So immediately the market is selling from here to the other block, you should be looking out for sell, right? So, and you make sure you see what shows you that, oh, this market is actually going to sell. Like an example, I showed you guys why you should be looking out for buy on this spot to the upside is because markets created a break of structure here, created a demand zone, created a liquidity. That shows that this setup is valid. You understand? So your buy is valid. Same confirmation here. After making a broke structure, this was a demand zone. This was a demand zone here, right? This was a demand zone. This was your liquidity. This was the first pullback it made at the higher time frame. This is your liquidity. Then all throughout here, you should be looking at for sell. So there was a liquidity over here. This was a fair value gap market reacted to. I will soon make a video about how to use a fair value gap. So market reacted to this fair value gap. This was a zone. It reacted to a point of interest on this zone after this liquidity. That is the reason market sold down here. So imagine you already shaked this stuff on your higher time frame that, oh, I should not be looking out for buys anymore, because after the reaction from here, you have to be looking out for buys till it gets to a point of interest that the market is no longer going to be buying anymore. Then you change to your buyers. So what the higher time frame tells you, it's what you are going to do on the lower time frame. The market is an uptrend, you look for a buy on the lower time frame. You understand? So you are not a swing trader. If you're a swing trader, you intend to use 4 hours or 2 hours for your entry. But as a day trader, you have to enter with your 15 minutes time frame, because you don't really want to like take long in the market for market to like smash your TP. You understand? Like 2 to 3 hours, you're out of the market already. So it's how to cross check the trend. Just follow this way. The market is a buy on the higher time frame. You come to your 15 minutes time frame. So let's check out for this sell. Assuming I was looking at for sell from this zone to this zone. Let's come to our 30 minutes time frame. So I have seen a good reaction on this zone. So I've seen a good reaction from this spot come down, and what I should be waiting for is market to break structure from here, right? After market broke structure, I found a good setup from here. This was my point of interest. That is my supply zone, and before the supply zone you can find this liquidity right here. So I can sell from this zone. This zone becomes my entry. Then I set my stop loss here. Then I can target the next low, that is 1:3, or I target the next liquidity, that is 1:9. You understand? So you just keep on this another entry. After this break of structure, this was the supply zone. This was your liquidity. So make sure is always take the zones that there are liquidity closer to it. So even though you see like 3 zones, you should take the one that is closer to the liquidity, and your buyers should be told by your higher time frame. So your higher time frame should tell you what you actually do on your lower time frame. So check your higher time frame is a buy. Come to your 4 hours time frame to check for more confirmation. Is this movement actually clear? Once it's clear, you come to your 15 minutes time frame. You wait for your market structure shift. That is your change of character, or you wait for a break of structure. Look out for your liquidity and spot your point of interest. Then you are into the market. Just that simple. Nothing much about it. You understand? So once you understand top down analysis very well, you will hardly be taking losses in the market, because now you understand the next buyers or the next movement of the market. So thank you guys. So you guys should subscribe. I'll make a video about the fair value gap later.